Your 401k just got a massive upgrade that 99% of people don't know about yet. While you've been stuck choosing between boring mutual funds, a game-changing executive order just opened the floodgates to investments like private equity, hedge funds that were once reserved for the ultra-wealthy, and I never thought I would see the day, but also cryptocurrency. But here's the million-dollar question. Should you actually invest in them? Hey, this is Brian, the Wealth Decisions Guy. I'm also the author of Momentous Decisions, 7 Steps to Better Health, More Wealth, and a Richer Life, and the founder of Momentous Wealth Advisors. And today we're discussing the new 401k options. By the end of this episode, you'll be able to decide whether they deserve a place in your 401k investment mix. After all, Harvard invests in these types of investment options, so should you, right? All right, wealth builders, let's get into this. The ERISA executive order has opened the door to more sophisticated options that are used by some of the largest private universities, pension funds, and foundations. The Harvard Endowment's asset allocation, for instance, in the fiscal year 2024 featured a lot of heavy investments in alternative assets, with 39% in private equity, 32% in hedge funds, and a smaller allocation to public equities, which was only 14%. Now, before we go full Gordon Gekko here, let's talk about what this actually means for you. The Department of Labor has given plan sponsors the green light to include alternative investments in 401k menus. We're talking about private equity, hedge funds, real estate investment trusts, and commodities. And yes, even cryptocurrency in some cases. Here's where most people are going to mess this up. They're going to treat these new options like Pokemon cards. You got to catch them all. That's not wealth building. That's throwing darts and hoping you hit the dartboard. Before we get into more of this episode, I've been doing this podcast for over a year because I love to help people make better wealth decisions. So if you find value in this episode, hit that subscribe button and make sure you stick around to the very end because I'm going to give you a step-by-step action plan that could make a significant difference to your financial future. And also head down to pinned comment number 1, where I ask, where do you have most of your money in your 401k? And also pinned comment number 2 after you've listened to this episode is, how much do you think you should allocate to alternative investments in your 401k? Coming up in just a few minutes, I'm going to reveal the one alternative investment that even conservative investors should consider and why the timing might be just about perfect right now. But first, let me share our first wealth decision principle. Diversification isn't about having more options. It's about having better options. So what should you actually do with these new options? First, understand what problems they're solving. Private equity, for example, gives you access to companies before they go public. It's like getting backstage passes to see bands before they hit the radio. The potential returns can be higher, but you're also locked in longer and taking on more risk. REITs, or real estate investment trusts, let you own property without becoming a landlord. No midnight calls about broken toilets, but you still get exposure to real estate appreciation and income. Now let's talk just a little bit about commodities. They can be great inflation hedges. If you remember the 80s when everything was about excess, well, inflation was making a huge comeback, and commodities were a great hedge against rising prices. But are they worth your dollars now that inflation has started to come down? So we'll get into that later in this episode. So let's talk about our second wealth decision principle. Your 401k allocation should reflect your age, but your alternative options should reflect your goals. If you're 25, you can afford to swing for the fences a little bit more with some of these alternative investments. If you're 55, you probably want to use them more strategically. So now let's talk about kind of the elephant in the room, cryptocurrencies and 401ks. I never thought I'd see the day. I know, your nephew told you Bitcoin is going to the moon, but here's the thing. Putting crypto in your retirement account is like putting hot sauce on everything. A little bit, but it adds the flavor, but too much will ruin the whole meal. Most financial advisors are either completely against crypto or they're telling you to go all in. Both approaches are wrong, in my opinion. I suggest no more than 5% of your total portfolio in crypto and predominantly in a Bitcoin ETF. But only if you can sleep at night knowing that your Bitcoin could go down 30 to 40%. So let's talk about some of the historical returns of the new asset classes that will be available in your 401k soon. Let's go all the way back to 1994 through 2024. So 30 years of performance. REITs have demonstrated really strong performance. They typically have returned about 11.3%, and they've outperformed the broad U.S. stock market during 82% of available 30-year periods, according to Motley Fool. Commodities have shown more modest and volatile returns over a 30-year period. They have lower correlation to other asset classes, making them a great diversifier, but their performance has been very weak compared to other asset classes. They always typically do well in high inflation periods, but over the last 30 years, commodities have returned about 6.67% based upon Bloomberg data. Now let's talk about private equity over the last 30 years. Private equity has delivered the strongest returns among alternative investments. According to Cambridge Associates data as of December 31st, 2023, private equity funds delivered an average annual return of about 13.1%, well ahead of the 8.6% average return the S&P has had over that particular period. So when you look at over the last 30 years, REITs and private equity have offered more attractive returns than the S&P 500, with private equity delivering the highest of the three options. And REITs also performed very strong with consistent returns and better liquidity than private equity. Commodities offered more modest returns, but they do offer some valuable diversification benefits, especially during inflationary periods. All three asset classes have provided meaningful diversification benefits. And now the big question becomes, do all three of these asset classes belong in your portfolio? I didn't bring up cryptocurrency performance because there's so many different cryptocurrencies. When you look at Bitcoin, you might be thinking, man, if I only put 10,000 in Bitcoin when it was 1,000 per coin, I'd be a multimillionaire today. But that's not what cryptocurrency is about. And does it belong in your portfolio? I've talked about this in past episodes. If you are 10 to 15 years away from retiring, a 3 to 5% allocation may be appropriate. If you're 3 to 5 years away from retiring, I don't think Bitcoin or cryptocurrency should be in your investment portfolio. I've also talked about real estate investment trusts in past episodes. I do believe real estate investment trusts belong in a diversified portfolio, anywhere from 5 to an 8% allocation. As for private equity, you need to have a longer time horizon. You can see from the historical performance that private equity does add a lot of value because you're getting involved in the next best companies before they go public. Coming up next, the three questions you must ask your HR department that most people never think to ask. Here's what nobody's talking about. Not all 401k plans are going to offer these options immediately. Some plan sponsors are moving faster than others. It's like when Netflix first came out, some people got it right away and others, waited years. So be proactive. Ask your HR department these three critical questions. First, what alternative investments are being considered for our 401k plan? Second, what's the timeline for the implementation? And third, what additional fees will these options carry? Now, that third question is huge. Alternative investments often come with higher fees than traditional mutual funds. We're talking management fees, performance fees, and sometimes fees on top of fees. It's like buying a car and finding out the wheels are extra. So wealth decision principle number 3, don't avoid an investment option just because of higher fees. If it provides diversification benefits and can make your portfolio better, then allocate an appropriate amount to that option. In just a few minutes, I'm going to give the exact action plan you need to evaluate these new options for your specific situation. Before we get to your action plan, let me address the question I know you're thinking. Brian, should I actually use these new options? The answer is yes and no. It all depends on your specific situation. If you're already maximizing your employer match and have a solid foundation with low-cost index funds, then yes, adding some alternative investments might make some sense. But if you're still trying to figure out the basics, these new options are like trying to learn advanced calculus when you haven't even mastered basic math yet. So here's your step-by-step action plan. Step number 1, audit your current 401k allocation. Are you maximizing your employer match? Do you have a solid foundation with diversified, low-cost funds or target date funds? Step number 2, educate yourself on the specific alternative options your plan offers. Don't just read the marketing materials, dig into the fees, the liquidity terms, and the risk factors. Step number 3 is start small. If you decide to add alternatives, begin with no more than 5 to 10% of your total allocation. You can always increase this later. Step number 4, rebalance on a regular basis. Alternative investments can behave differently than traditional assets, so your allocation might drift over time. Keep up on your portfolio and rebalance to your target mix. Step number 5, review and adjust annually. What made sense this year might not make sense next year as your situation changes. And always remember, the goal isn't to have the most complex portfolio. It's to have the most effective one for your specific situation. These new 401k options are tools, and like any tool, they're only as good as the person using them. If you found this episode valuable, do me a favor and head over to the second pinned comment where I've asked what percentage of your 401k would you feel comfortable allocating to alternative investments. I'm really curious about your thoughts, and I do read every response. And one of your answers just might inspire a future episode of the Wealth Decisions podcast. Next week, I'm diving into rich life design, why your bank account reflects your identity, not your income. This is Brian, the Wealth Decisions guy, and keep making those wealth decisions count. And I would love if you pre-ordered my new book, Momentous Decisions, 7 Steps to Better Health, More Wealth, and a Richer Life. You can find a link to order your copy in the description of this podcast. And once again, thanks for listening, and we'll see you next week.